Banks across America have stopped lending, plunging the U.S. economy into a credit crunch in 2023, with Bloomberg reporting that U.S. bank lending has slumped by the most on record in the final weeks of March, a nearly $105 billion drop in lending in just 2 weeks. This credit crunch greatly increases the chances that America is going to have a deflationary recession or depression at some point in 2023, and in fact, we could already be in it, everyone, particularly in the manufacturing sector, everyone, where the ISM Manufacturing Index fell to 46.3 in March. That's the worst reading for new orders, output, and employment in the manufacturing sector since 2009. And ultimately, everyone, this is going to lead to an increase in layoffs and job losses, and not just, layoffs in the headlines at tech companies. We're going to see the unemployment rate start to spike in America in the second half of 2023. In fact, we're already seeing a big increase in unemployment claims. Data from the Federal Reserve shows that continued unemployment claims has surged since September, when it reached a bottom at 1.3 million people. That's now all the way up to 1.8 million at the end of March, beginning of April. More people on the unemployment roll is a signal about what's going on in the economy, everyone. It's not good. Additionally, ADP, the private payroll company, just came out with a new jobs report last week that showed that America added 150,000 jobs. Now, that was still positive job growth, but when you dig into the employment report that ADP released, the numbers weren't so good for certain parts of the country. Particularly the South, everyone. We can see that according to ADP jobs numbers, the South has lost employment over the first 2 to 3 months of 2023. You can see the western southern region of Texas, Oklahoma, Arkansas, and Louisiana has lost 161,000 jobs. South Atlantic, including Florida, Georgia, South Carolina, North Carolina, has lost 100,000 jobs. We also have areas like Tennessee and Alabama losing jobs. And so this is not good for the housing market, everyone. All these recessionary headwinds and job losses, particularly in the South, because the South is building lots and lots of new homes and apartments. There's almost 800,000 homes and apartments actively under construction in the South as we speak. That's a record high, even higher than the '06 bubble, and it's almost 2 times as much construction as on the West Coast and 4 times as much construction in the Northeast and Midwest. So if those ADP payroll numbers prove to be part of a trend and we're going to see more job losses in the South, that's going to mean lower home prices and more inventory throughout those housing markets, given how much construction there is. And I'll be sure to update you all on that data in the future, but really what we got to talk about now is mortgages and mortgage defaults, everyone, because we're seeing a big surge in mortgage defaults right now across America, particularly on what's called FHA mortgages. FHA mortgages are these first-time homebuyer loans that the U.S. government sponsors and allows people to only put 3 to 5% down. Well, these loans now have a 12% default rate in the most recent month in February 2023. And the 30-day default rate on these loans has gone up from 4.3% last year to 5.4% this year. Additionally, the 60-day default rate is increasing significantly as well. That's a sign that low-income homeowners in America are struggling right now when you see those 30 and 60-day default rates go up. And that's going to mean, you guessed it, forced sales and foreclosures in the second half of 2023 and into 2024. And one of the biggest misnomers about the housing market that really bothers me is that people think that there won't be foreclosures this time around, because there's this idea that all the loans are good loans in the housing market, and that after the subprime crisis we learned our lesson and only make good loans to good borrowers. But folks, that is not the case. To see what I'm talking about, check out this graph, everyone, which is looking at the debt to income ratio for government-backed home purchase mortgages over the last 25 or so years. And what do you notice is that in the middle of 2022, the debt to income ratio was 44% for FHA and VA loan mortgage borrowers, which was actually higher than the peak in 07-08 in the last bubble. So what this means, just want to make sure you guys get this clear, is that the FHA mortgage borrowers are actually taking on more mortgage interest and mortgage debt relative to their income today than they were back in the mid-2000s bubble. And the reason they're doing that is because the US government is allowing them to do that. The Biden administration has been very aggressive in wanting to expand mortgage access to low-income borrowers who can't afford these mortgages. And they do this under the guise of expanding the benefits of home ownership to everyone. But really what they're doing is they're saddling, at-risk economic households with a lot of debt near the peak of a housing bubble where the crash has already started, on the doorstep of a recession. I mean, how do we think that's going to end up for a lot of these FHA mortgage borrowers who are literally having to spend almost half of their income on their debt get in their mortgage payments after they buy the house. And one thing now that the administration is now floating is 40-year mortgages. The Federal Housing Administration has now greenlit 40-year mortgages, which is designed to try to make it easier for first-time homebuyers to get into a house by stretching out the mortgage term, which lowers the monthly payment from maybe $2,000 a month to $1,900 a month, but ends up increasing the total interest owed over the duration of the mortgage by something like $170,000 in this example. And so if some of you are wondering why maybe the housing market is not crashing as fast as you want it to, it's because the US federal government is actively trying to push as many low-income borrowers into the housing market as possible at the worst possible time. But of course, I don't think the government's going to be very successful here because literally the recession is already starting. The mortgage defaults for FHA borrowers are already surging, and we're just going to see the situation get worse, especially as the credit crunch continues to play out. This is a graph showing the bank credit offered by commercial banks in America, everyone. What do you notice? Bank credit kind of went up gradually over the course of last year, and then as soon as Silicon Valley hit, boom, bank credit contracted significantly, less money going into the economy from commercial banks. And if we look year over year, bank credit growth is now only 2.7% higher now compared to where it was a year ago, which is problematic. We can see, folks, that big decelerations in bank credit historically have been heavily correlated with recessions, because after all, when banks tighten the belt and businesses can no longer get loans, businesses have to shut down. Or what businesses have to do is they have to start, liquidating their holdings and taking whatever cash they have and using it to pay expenses. And this is actually a concern of mine, folks. And I don't want to get too, let's just call it doomsday here in this video. But one thing I think that could happen is this bank credit crunch, which is occurring right now, could cause even more bank runs in the future. Because if businesses start to not to be able to get financing, they're probably going to have to take whatever bank deposits they have, and they're going to have to use those bank deposits to cover expenses, which could theoretically cause more bank runs as people take money out of the bank. Now, I'm not saying that's definitely going to happen, but it's something that definitely could happen, especially in this monetary environment where Jerome Powell and the Federal Reserve is continuing to contract the money supply through quantitative tightening. Yes, the Fed did print $300 billion in the short term to bail out Silicon Valley Bank, but since then, the opposite has started to occur, and the Fed balance sheet is now being reduced again. You can see the quantitative tightening that was occurring, and then the printing they did for Silicon Valley Bank. Well, now the quantitative tightening is back on, everyone. And so, folks, this is like a crazy situation we have, that the banks are tightening credit, the Fed is tightening credit, while inflation is still a big problem. Inflation is still 6% year over year, and now we have, OPEC deciding to cut oil production, which is already starting to cause gas prices to go up. And so inflation is likely to still be problematic over the next 2 to 3 months, which really leaves the Federal Reserve in a very interesting position right now. I would not want to be Jerome Powell, because on one hand, we have the writing on the wall for a deflationary recession with lots of job losses. Like, the wheels are in motion on that. Everyone can kind of see it coming, but then inflation is still the main problem in the present and in the short term. And so what does the Fed do at their next meeting in May? Well, according to the betting markets, the CME Fed Watch tool, there's a now 67% chance that the Fed is going to hike interest rates again by 25 basis points at their next meeting in about a month, compared to a 33% chance that they keep rates where they are currently. And folks, I'm starting to get into the camp here that I don't think the Fed should increase anymore. I mean, it's so clear where the economy's going. And if the Fed increases rates more, it's just going to cause an even bigger crash, which, I don't know, some of you might say maybe the economy needs a big crash to sort things out. Maybe we need a big deflationary episode. But the thing is, the Fed is not very good at being subtle, right? They're not very good at nudging things in a certain direction. And I fear that they're going to end up making this downturn so bad that they're then going to be forced to do something crazy in response. And maybe then there's going to be more money printing in a year or two. And we're going to be in this cycle over and over again. And so I would say, Jerome Powell, probably time to stop hiking interest rates, but the betting markets say that he should continue hiking. So we'll see. Additionally, the bond market is predicting that Powell is going to stop hiking rates as well. Over the last month, the 10-year Treasury yield's fallen from about 4% all the way down to 3.4%. And these declining long-term bond yields are now pushing mortgage rates back down. The 30-year fixed mortgage rate has gone from 7% about a month ago to 6.2, 6.3% today. And I see some people now saying that due to this, let's call it a marginal decline in mortgage rates, we're going to see an increase in demand in the housing market. Like lots of realtors and investors are spinning this narrative. They're almost, wanting you to think that a banking crisis and a recession is good for the housing market because mortgage rates are going down. But there's a problem, folks. Mortgage rates going down has not enticed more home buyers back into the market. The level of mortgage demand and mortgage applications to buy a house is still literally at the lowest level in almost 3 decades. As you can see on this graph, where we're looking at the weekly mortgage application index to buy a house, and the most recent week showed a mortgage application index of 167, which was down 35% from where it was a year ago and down about 45% from where it was 2 years ago at the peak of the pandemic. And you can see this yellow dotted line. The current level of mortgage application demand is on par with what we saw basically in the worst of the last housing crash in 2008, 2009, 2010. And so no, there is no recovery in fundamental home buyer demand in the housing market. Contrary to what certain people are trying to tell you on YouTube or in the mainstream media, that is not happening. The regular home buyer is still out on the housing market and is not returning. Why is that? Well, Americans aren't dumb, everyone. They know that it's a bad time to buy a house right now. According to Fannie Mae's National Housing Survey that just came out today, consumer confidence in the housing market remains near record lows. In particular, the net percentage of people who think it's a good time to buy a house is literally at the lowest level in the history of the survey. Now, but I'm sure you guys are wondering, well, if that's the case, if home buyers are out, why does it appear like in certain housing markets there's bidding wars? Or why is inventory low in certain markets in the US housing market? And the answer is simple, everyone. It's not due to an increase in fundamental buyer demand. Rather, it's due to sellers being stubborn and sellers not wanting to list their properties. Data from Redfin shows that new seller listings onto the housing market are down about 22% from where they were last year. And that is fundamentally what is keeping inventory lower in certain cities on the US housing market and creating the false perception that there's an actual recovery going on. But folks, I think we all know eventually these people are going to sell, especially because a lot of them are not able to afford their mortgage payments. I showed you guys this data set earlier on the debt to income ratio for FHA loans. Home buyers are paying the most they ever have relative to their income to afford their house for FHA loans. But it's also similar for the market overall. In the second quarter of 2022, about a year ago, which is the most recent data available from Fannie Mae, the typical home buyer had to spend 38% of their income on debt payments after they purchased their home. That was pretty similar to what the levels were in 06, 07 at the peak of the last bubble right before the last crash. And so maybe these sellers can hold out for 6 months or 9 months or maybe a year. Maybe they can hold out for a little while. But as the recession gets worse, the reality that most homeowners in America who have a mortgage are having to spend a near record share of their income to maintain the mortgage and maintain the house, that's going to break at a certain point, and people will eventually be forced to list their houses. Either through they run out of money, the personal savings rate in America is only 4%, or maybe they get laid off from their job and need to sell, that second home that they bought for fun, that they were Airbnb-ing. There's a variety of different ways and mechanisms for inventory and listings on the US housing market to increase and increase fast. And I'm going to tell you actually, folks, what concerns me most of all the things I've talked about in this video is, the bank credit, right? And the declining bank loans and the declining bank deposits. That is likely to cause the money supply in America to contract even further. And I'm going to show you guys a graph that I've already shown you a couple times in the last month. And this graph comes from a tweet that I actually made on March 8th, before the Silicon Valley bank crisis. I tweeted about how the money supply in America was contracting and how every other time in history it contracted, which was 4 times, we had a depression, a panic, and a banking crisis. And this money supply is likely to continue contracting as banks give fewer loans and as the Federal Reserve continues to do quantitative tightening. And if that continues, if the money supply continues to contract, our economy is going to have massive problems. Because basically what's going to happen is the supply of money is going to be going down, just as inflation in the short term is still a problem going up. And eventually these two are going to meet and cause huge issues. And I fear large levels of unemployment and layoffs. Of course, that is not a guarantee. But to me, that is how the pieces on the chessboard are moving right now. And it's something that I think a lot of you should be preparing for. Whether you're a home buyer or an investor, start thinking that this inflation is not going to be able to last for much longer, and that we're going to have bigger problems in the economy related to credit, related to money supply, related to a recession and unemployment. And the way to protect yourself in this type of environment is to actually, number one, hold cash. Holding cash is a decent option in this type of situation. Another would be to buy a CD. There's a lot of CDs out there, certificates of deposit, that are now paying 4 to 5% for a 6 or 12 month CD. Additionally, you could buy US Treasury bonds. The short-term treasuries especially are yielding anywhere from 4 to 4.5%. Basically, what you want to do in a deflationary recession or depression type environment is avoid leveraging, avoid taking out debt, avoid making big purchases, and keep yourself liquid. Now, as I said, this deflationary environment is not a guarantee because the federal government and the Federal Reserve does not want it to happen. And so as there's more pressure, downward pressure on prices, upward pressure on employment, we are going to see the Fed pivot. I think they're going to pivot in their next meeting or two. I don't know if the betting market's right that the Fed's going to increase rates again because the economy is heading south fast. And when the Fed pivots, there's also going to be government pressure to come to the rescue from the fiscal side. I could see the Biden administration wanting to stroke stimulus checks again to keep the economy going. I mean, the one thing Biden showed is that he's going to do anything he can possible to keep the economy afloat until next year's election. The counterweight against that is that right now Congress is controlled by Republicans, and there's currently a big debate and battle just about the debt ceiling. And so I think it's going to be very difficult for the US government fiscally to inject money into the economy over the next 6 to 12 months, even if things start to go south. There's also one other thing that could kind of prevent a deflationary crash and cause inflation to get worse in the future, and that's if the US dollar plummets. And we're starting to see the initial signs of this with countries like China discussing an Asian monetary fund to cut their dependency on the US dollar. And ultimately, what this could theoretically do in the long run, if enough countries get on board with the idea that we don't want to use the dollar as a reserve currency, we don't want to use dollar to trade oil, we don't want to use dollar to trade with each other, it could lead to all of the massive monetary reserves of dollars sitting overseas in what's called the Eurodollar system. It could lead to those dollars flowing back to America and getting dumped on the US shore and basically increasing the money supply domestically. So right now, the M2 money supply in America is about $21 trillion, and it's contracting, as I said before. But if this de-dollarization occurs and China and Russia and Brazil and all these countries dump their dollars back onto America, it could then cause the money supply, the M2 money supply in America, to go up, which would create more inflation. Now, what's the likelihood that this is going to happen? I think it's actually pretty good that it's going to happen at some point. The thing is, it's likely more of a long-term play and long-term situation that I think is probably going to take 5 years, 10 years, 15, 20 years to play out, because it's not very easy all of a sudden for these countries to just abandon the dollar, because it's very convenient to do business in the dollar. And right now, according to the IMF, 58% of all global reserve currencies are US dollars. 6.5 trillion, in fact, of the 11 trillion. And you could see the second place is the euro, around 20%. The Chinese yuan is all the way down at 2.7% of global reserve currencies. And so there's still a long way to go for the rest of the world to abandon the dollar. And so I don't think that's going to happen overnight, which leads me to believe that the shorter term situation of 2 to 3 years is going to be deflation. It's going to be money supply contraction, bank credit crunch, not enough loans and liquidity in the economy causing unemployment and prices of things to go down. That's what I see as the most likely outcome the next 2 to 3 years. But then maybe after that, at some point when inevitably more money printing occurs and the Fed lowers interest rates and the economy recovers, then we could see maybe some real inflation problems in the long run with de-dollarization. So guys, I hope you enjoyed this video. I know I threw a lot of stuff at you here, but let me know in the comments what you thought about the video, and also let me know about what do you think is going to be the direction of the economy. Is it going to be deflation? Is it going to be inflation? Or is it going to be stagflation? Is that going to be the outcome? I'm going to talk about the likelihood we have stagflation in a future video. Hit the subscribe button and turn your notifications on so you don't miss it.